Namaskar and hello friends, this is Rohit Devangan presenting to you moving average concepts, introduction to types to advanced strategies. What we'll be covering here is about 20 plus strategies and hello friends, this is Rohit Devangan presenting to you moving average concepts, introduction to types to advanced strategies. What we'll be covering here is about one moment strategies and sorry for that, there was some echo. I hope the voice quality has got better now. Starting from scratch, this is Rohit Devangan presenting to you moving average, introduction, strategies. What we'll be covering is about 20 plus strategies, and the session is likely to take about 2 hours, wherein we'll start with the most basic concepts to the moving average types and advanced strategies and how to implement them and use them in topstockresearch.com. All right, so what we'll be covering here is basic moving average concepts, types, usage of moving averages, moving average, where can you plot moving average on various fields, open, high, low, close, volume, and other technical indicators, moving average to identify trend, trend strength, and trend direction, covering 20 plus strategies, and what is the right moving average based on your trading style, moving average, how to use moving average in topstockresearch.com, backtesting of moving average, time machine, and we'll understand that how can you use Top Stock Research as all-in-one stock analytical tool, learning, screening, testing, and viewing in charts. So Top Stock Research covers all these key functionalities what is required for a typical trader, both for intraday as well as end of the day or institution traders. Right? Key concept. So basically, why do we need moving average? So what happens is when the price typically moves in much more erratic or much more stronger fashion compared to the overall trend, right? So what moving average helps you is to basically reduce the typical noise, which can be intraday or can be one single upward movement or a downward movement, and helps you to find the trend direction. Just hold for a second. Right. So basically, moving average helps you to distinguish between typical market noise and the actual trend direction. So when you see over here, the price typically moves with a lot of ups and downs, and this we have seen or we have gone through in greater details in price action and some of the technical analytical tools in the sessions that we had, wherein price moves in trends. The trends can be a simple trend, or it can be a trend of trend, it can be complex trend, right? But price rarely moves in one direction, and if it does move in one direction, that's a very short-lived time, right? So basically, getting the sense of where the price is moving, right? What we do is we plot a moving average. So it is an average of the price over a period of time, and we plot along with that. So in this particular case, in this example, you'll see that price is going up, coming down, going up, coming down, and so on and so forth. So the typical analyst sometimes finds it difficult to see where exactly the trend is, right? That's where moving average comes into picture, and it is plotted on the average of the price, and it gives a smoothing idea. So in this particular case, even though market is going up, down, moving average tells you the larger direction of the price movement or the trend, right? So this is the typical advantage of moving average. It also helps you to find uptrend. Similarly, it helps you to find downtrend. Also, it helps you to find that whether the market is trending or not. So when moving average is typically goes in a flattish mode, right, or parallel to the date axis, or goes in the flattish mode, then what it tells you is that price is not moving in a particular direction, or in fact it is either in consolidation phase or it is in the sideways market where it is you're not very clearly able to do it, right? So depending on the kind of moving average, depending on the time of horizon you have, what time period you are looking for, there's a suitable moving average, and which will help you to find this. So for example, in this moving average, if this is a 200-day moving average, right, perhaps some other moving average, a shorter moving average, may be showing you a trend or two, right? Or similarly upward, downward trends. So depending on the moving average that you choose, you can find different moving average behaving in different ways, which we'll see in a short time. So the key is moving average helps you to find the trend depending on the kind of moving average you have taken. Moving average usage, as we have briefly covered it, it helps you to find the trend direction, shift in the trend direction, identify the strength of the trend. It provides dynamic support and resistance to the price. It can be used as trailing stop loss and can be used as an entry and exit points for your trade. Moving average for trend direction. So what happens is when the price crosses above a certain moving average, right? When the price crosses above a certain moving average, it typically tells you the strength of the or basically a change of the direction of the price, right? So in this particular case, when the price crosses above a moving average, it is a bullish trend, and it clearly, as the signal also shows that it's bullish, it is start of a trend. But the trend strength is not absolute. So basically what it tells is the reliability of such a thing is about 50-50, right? If it just crosses above this thing, it's 50-50. You have to look at some of the other aspects also. Aggressive traders can get here. Relatively cautious trader will have to see that the price is above moving average for a certain period of time before they enter into the trade, and the moving average direction also changes, right? So prices, sometimes what happens is price goes up and comes down as sharply as it has gone up, right? So there can be a sideways market or there can be a whipsaw. So what a relatively conservative trader should do is they should also look for the change of the direction of this thing, right? So one is the crossover. Aggressive traders, relatively conservative, can look for either change of direction or can see that the divergence here. So here it is very close. Here it is going up. Again it is going up. So there's sort of a divergence here, right? So one of the thing is, if the distance between the two is moving at a faster rate compared to then obviously it's a positive sign. There's another signal where the direction of the line also changes, right? So if the price is above moving average, it should give you better confidence, right? So that's why the reliability is better. Number three, even better. Even better is price is also moving up and moving average is also moving up. That means the price is consistently moving in such a way that the whatever the lag of the moving average, will understand what lag is in a short while. But for the time being, just understand that if the price is moving up and also it is taking the moving average along with it in the upper direction, that should give even better reliability of the trend, right? So three things that we have seen in the trend, right? In some of the previous sessions, we have seen trend in purely price action based. We have seen trend using certain technical indicators like MACD or ADX. This is another way of finding the trend of the underlying stock, right? So according to where it is, we have marked, or we have tried to mark in a way which is easy for you to understand. If you do understand, if you find these kind of animations and other things useful, please write a comment or two so that we'll work on that. If you feel that there's too elementary, also mention that. Next time we'll take the session at based on your feedbacks, right? What kind of feedbacks are coming. So this will be a typical way to find the trend. So one is aggressive, relatively conservative, and then people who are looking for a slightly longer term, then they'll have to look at the other things, right? And then automatically the reliability also increases as the number of signal increases. But if the number of confirmation that you are looking for, right, perhaps you'll miss some of the good movements. So aggressive traders can get better compared to slightly conservative, and then compared to the very risk averse traders. Similarly, just opposite of that is bearish crossover. So crossover, price below moving average, bearish trend, and then price and moving average both trending down in the trending in the same direction, which is the downtrend. MA for strength identification. So what happens is, so maybe it's a small. It's time for me to tell you what a moving average is and how does it look like in one of the real world example, right? So we go to charts. In the charts, this is Top Stock Research chart. What you do is you have certain moving average which is pre-selected or pre-created for you, or you can go and look at one of the moving average. So what we have is Nifty charts, right? And then what we can do is we can plot a simple moving average. You plot a moving average, right? So the 50 moving average is there. Now, if you see, this is 50 moving average. If we plot another moving average, maybe a 20 moving average, 20 simple moving average, right? So if you see over here, 20 moving average is almost like getting flattish here because the market is in the sideways direction. The 20-day moving average was coming down because the market was trending down, right? So that's how it will typically show you. So this was a simple illustration of what a moving average looks like, right? It clearly tells you that much more smoother signal. So if we remove or maybe if we draw long, right? So this was a very, very nice trend. This was a very, very nice trend. So the moving average was there. So price is moving up, moving average is moving up, right? This is where the crossover has happened, right? This is where the crossover has happened, and the price is moving up, moving average is moving up. Aggressive traders would come here, slightly risk averse trader will wait for signal to change, and the lesser risky ones or risk averse one would come here, that so that the price is trending, this is trending, right? So this is a very simple or very, very simplistic view of showing moving average, right? This is not the absolute things that you should be looking at. Just seeing these three things, you should go in the course of this session. We'll tell you which moving average to choose, what is the moving average. So if you see over here, there are quite a few moving averages available in the system, right? We'll try to go through some of them one by one. Okay, so in this example, what we have seen is there are two moving average, right? So what's happening is the two moving average, they are pretty far. They are getting converged into, or they are converging into a single point, right? Which is zone of uncertainty, right? And then when they start diverging, when they start after a crossover, when they start diverging, that should give better strength. All these terms, if you are unfamiliar with, don't worry. We'll go through each one of them with examples, with screeners, so that all these basic concepts gets clear, right? So what's happening is there are two moving average, which when they are converging, that means it is a sideways market, and it's not very clear where it is going to be, right? So this is where the moving average converges. During the convergence point, it's not so good a thing. So that tells that the trend is weakening. As we can see, that trend is weakening. Then there's a crossover. So what it means is there are two moving averages out here. One is the short term, which is blue line, right? And second is long term, which is green line, right? So when the blue line, when the shorter moving average crosses above the longer moving average, that means there is a possibility of change in the direction of trend, because shorter moving average will react faster to the latest price movement. Longer moving average will react slower. Don't worry if you don't understand at this point of time. We have certain examples which will help you to explain that. But for the time being, the shorter the moving average, the closer it is to the price. The longer the moving average, the farther it is from the price, right? So depending on what kind of trader you are, if you are a short-term trader, obviously you should be looking for shorter moving average. If you are a long-term trader or basically a fundamental analyst and looking for moving average, then perhaps what you should be looking at is 50 or 100 or 50 or 200 day moving average. That's what most of the typical institutions, FIs or DIs, they use for actual investment, right? For trading, shorter; for investment, longer moving average. So the moving average here is converging. This is where the crossover has happened, right? So it is what it signals is trend change, right? This is where the trend is changing. And the third one is when these two moving average starts moving away from each other, not really moving away from each other, when the difference between the two moving average increases, right? This is where it is called divergence, right? Don't confuse it with convergence and divergence as MACD. MACD is a different indicator. Obviously, it is based on moving average, but that divergence and this divergences are different, right? What we are trying to explain you, the concept is slightly different than MACD, right? So when the shorter moving average is moving much faster than the larger moving average, right? That means the short-term strength is much better. And also the confirmation here is the longer moving average is also moving in that direction. So that should give you better confidence in the trade. Okay. Moving average can be used for support and resistance. So a lot of times you'll see that the price moving in a certain price moving, and when they are about to touch or very close to a moving average, it bounces back. So like what we have seen in the price action session in the trend lines, the trend line provides you dynamic support and resistance. That is a single straight line, whereas moving average is not a straight line, but it provides a dynamic support and resistance. So when the price comes very close to a moving average, there is a likelihood that the price will retrace from that level. So in this particular example, the price is moving in this direction, coming very close to the moving average, going up, again coming back to the moving average, and perhaps it will go up, or we'll see some of the examples, right? Similarly, moving average acts as a resistance. So if the price is below the moving average, then as soon as it's about to reach this level, right, this will act as a dynamic resistance level. So if the price is coming closer to this and retracing back, that means it's giving a proper good resistance, and some kind of sell-off can happen. Some kind of sell-off can happen at this level. Some buying can happen at this level, right? So we'll see some of the examples of this moving average support and resistance in greater details. Right? So what a typical example which my team has brought out is moving average, two moving average crossing each other, right? A bullish moving average crossover, and then they are diverging, and then again they are starting to converge, and they are in the range of when they are very close to each other, right? That's where it tells you the sideways market, right? This is the place where certain caution needs to be there. If you are looking for basically a few things can be done here is either you can book some of the profits out here, right? When they are about to converge, that means it's changing the direction, or basically you can book partial profit, or you can exit, or you can wait for some other signals to happen, right? So the moving average, when the shorter moving average here in this case is 20 EMA is crossing above 50 EMA, then there's a bullish signal is there. It's the gap between the two is widening, which is a good sign. Both 50 and 20 are moving upwards. That's again a good sign. And then you have to wait till the signal reversal is happening, which has happened in this particular zone or zone of uncertainty, where the price, moving average, all are converging pretty much each other, and there's a lot of choppiness in the market, right? The change of direction is happening here, right? Is happening here. What you should be looking for is, now the typical question would be is, why, how do we know that at this point it's changing and not at this point or this point, right? So what you should be looking at is some additional indicators. Some of it we have covered in the previous sessions, like in the candlestick session that we have had a couple of weeks back. If you see certain good patterns forming there, the volume participation is good there, right? Or there's a big candle or some other technical signals like an RSI or a MACD or ADX, right? Then those will be the additional things which should help you to get confirmation along with the moving average, right? This is where the moving average crossover has happened. It's a good green signal, right? Then continuously green bars are there, right? So that should give you better strength, and it's rising up pretty steeply, right? It's rising up pretty steeply. So this should give you better confidence. Either you can accumulate, or you can increase the basically the trailing the stop loss. Now here this will act as a stop loss also, trailing stop loss, right? For the close price, this will be trailing stop loss. Either this can be a trailing stop loss, or the reverse crossover can be a trailing stop loss, right? So depending on what your strategy is, what strategy you pick, you can use either this as a stop loss or the convergence as the stop loss. Some of the strategies, both these strategies will explain in a short while. Okay. So just reverse of that is a bearish crossover. When the shorter moving average or when the longer moving average crosses below the shorter moving average, right? So basically this is where this a reversal happens. So bearish crossover. Similarly, bullish crossover happens. So this is a simple illustration of how to use two moving average for finding the crossover, right? So now, where do you find these moving average crossover? We'll go into the charts. So in this very simple charts, what we have done is we have plotted SMA. If you want to use other other moving average like an EMA, just go and change it to EMA, and you'll see. So as soon as you change things out here, right, you'll see the chart automatically gets plotted out here. Here you'll see that let's look at one of the moving average first, right, to see the difference between the two moving average. So this is 20 moving average, and then what we'll do is we'll plot another SMA of 20, right? So there are quite a few moving average. Not to get confused, each moving average has its merit and demerit. We'll see what those are. So the green one is simple moving average, and the red, the maroon one is exponential moving average. So if you see, the exponential moving average reacts much faster to the price compared to the simple moving average, right? Now that doesn't mean that exponential is better than simple. Both have their own place depending on your trading style and what your strategy is. Right? So coming back to the old example of taking two moving average crossovers, right? Typically this is how you'll plot two moving average, right? So the signal comes here, the two moving average crosses here, again with a good green candle, which should give you confirmation, followed by a gap up, right? So if you have attended the session of candlestick, then you'll understand what a gap up or the price action session, the gap up here. If you have not, don't worry. If there's a gap between the prices of two consecutive candlestick in one direction, then that's called gap up. That's a very bullish signal. If you have not attended, I'll recommend you to attend both price action session as well as candlestick session. Right, so there's a gap up, and then there's a nice movement coming up there, right? Now, and also the gap between the two moving average is basically widening, which should give you better confirmation. Only at this point, it's starting reducing, right? So depending on what your strategy is, you can start getting cautious when they are getting closer to each other, or when one of the moving averages breached, right? So certain things. Also, if you see, this is a typical evening star pattern. So along with the moving average, if you see that very close to moving average, if certain patterns are formed, right, then you can get little cautious or book the profit, or book at least partial profit, right, of your trade. And then the moving average, it is crossed below the moving averages, and then moving average itself has crossed, right, over here. There's a gap down here, and then moving average has crossed. So in this example, what we are trying to tell you is the two moving average. You can plot the two moving averages of your choice in the chart and then do it. Now, plotting in the chart is definitely one way, but this will give you only visibility to one stock at a time. If you want to look at all the stocks of a certain kind where certain moving average is crossing over, so what you can do is you can go into exponential moving average, wherein you can go for bullish crossover, and you can choose a 20 crossing over 50 moving average. There's no record on blue chip stocks. Let's increase the scope to NSE 500. We'll see that there are 4 stocks which are matching the criteria, wherein 20 moving average has crossed above 50 moving average. So when you look at the charts, you'll see that this is where the moving average is crossing over. Right. Also see there's a good volume up here. It was pretty flattish market. Right. It was a pretty flattish market for Hinduja Global. We'll look at candlestick chart. Right. So there's a sort of gap up out here. So this can be looked at multiple different perspectives. Purely from price action perspective, it has broken the resistance. So you again, as I have been saying in the other sessions, right, you start from one place, price action or technical indicator or moving average or any other place or other chart patterns, right, all will tend to give you very simple and similar signals. So if we just started from a moving average, you'll see that there are a lot of things which are coming in. If you understand price action, the resistance, the typical resistance point is, or the recent high is broken. Moving average was pretty much flattish. Moving average is changing direction, and then there's a good big green candle along with good volume, right? So there are a lot of positive things are coming. The next here is Indian hodl, right? This is where the moving average is crossing over, right? Again with a small gap up. The third one is this one, again with a good gap up. So you'll see a lot of gap ups here or a big candle. One of the prime reason is market performed exceedingly well in the last trading session. So that's why you'll see a lot of green candles, good volumes, and so on and so forth, right? So typical. What you can do is you can get the moving averages. For the convenience of our users, what we have done is we have plotted some of the most common moving averages out here, like 20, 50, 50, 200. This is called also called as another term, which we'll explain in a short while. But remember, 50 and 200 moving average is considered to be very important for the time being, right? So some of the important moving average, simple and exponential moving averages are pre-created for you. If you are looking for some more complex moving average, obviously you can go to custom screener, go to DIY, do it yourself screener. Over here, choose moving average. And if you are looking for two moving average crossover, So you can plot 20 crossing 20 above 50, right? So what you can do is you can get 20 moving average crossing above 50 moving average. So these are the examples where, no, sorry. So what we have done is 20 moving average above 50 moving average, right? Very simple, where you just are looking for whether 20 is above 50 moving average, right? What you can also do is you can go and say that cross above. So when you click here, you'll see that 20-day moving average has crossed above 50-day moving average for Berger paint, right? So you'll see that this is where the crossover is happening. Now, the example that we have done here is very simple one, 20 and 50, which was there in the other place. What you can do is you can add 13 and 34, another common moving average, but generally this is on EMAs. So let's plot an EMA where 13 EMA is crossing above 50 on a NSE 500 basket. So 13 moving average, the prices are here. When you go here and see that the 13 moving average is crossing above 50, above 34 moving average, right? So this is much better for us short-term or a swing trading, 13 and 34. Right? This is better. So you'll see all the examples where the 13 is crossing above 34. Right? All the examples are here. So you're not restricted with a standard moving average. You can choose any moving average between 2 to 200. You can plot above, below, crossing above. Sometimes it's important to see that it is crossed above in the previous tick, right? For the aggressive traders, cross above is enough. For some other traders, for traders who are looking for confirmation, crossing above in the previous tick. So when you go and look at this, crossing above in the previous tick, so you'll see the crossover has happened in the previous tick, not in the latest tick, right? Same way, you can look at the crossover has happened in the previous tick. Also, what you can do is, this was something which we did early. Now you have an option of saying that which tick it crossed over. So let's see that for the golden ratio of 50 and 200 moving average. Let's plot it here, right? So basically, there's a KNR construction where 50 and 200 day moving average has, sorry, what we need to do is cross above in the wrong. I think it's wrong. Yeah, right. So basically this is where the crossover has happened. If you want to look at the previous tick, you can go back in the history, look at, let's say, P minus 10, whatever the crossover has happened, right? So there are three or four crossovers happened on 17th of Feb. So just go and look at it. So this will help you to validate your concepts, right? When the crossover has happened, what's happening, right? What's happening after the crossover has happened, right? So you can go back in the history and see what has happened. So you can look at other things. Apart from this, you have an option of choosing various different moving averages, right? Also, you can plot on various fields. So you can plot moving average on close price, which is most common. You can also plot on open, high, low, and other variations of it, which we'll cover in a short while. Okay. So what we have covered is moving average crossover with certain examples and charts. Okay, so the next one is moving average. You can plot on various fields, right? So the most common one is close price. Also, sometimes it's useful, particularly when you're looking at support level or resistance level. Then the low and high are also important. You can plot on, so let's see one of the examples of plotting moving average on other fields. So we go to the charts. In this example, let's again go to a put stock or something which is traded a lot. Maybe Nifty. Okay. So in this Nifty, what we have done is we have plotted Nifty on a close price. Similarly, what you can do is if the Nifty if the price is below the moving average, right? So In this particular example, we have just taken one of the stock as at random, right? See, if you see, there are quite a few times where Nifty is almost retracing or almost bouncing back from that resistance level, right? One, this, another time here, third time here, right? So this, what we saw a while back in one of the previous slides, that this acts as a dynamic support and resistance level. So where in this case, it is acting as a dynamic resistance level, right? Once this level is reached, it has tried to come back here. It provided a resistance, and then provided another resistance in this thing, right? So if you see here, let's plot another 50 moving average on a, so since it is resistance, high would be a good point, right? Or what you can plot is another one on a low price. Right? So when you see these three things, right? So this one being the blue one is on the close price. The high, sometimes it's very useful to see where the high points are, where the moving average is. So you can plot high price as well as the low price, right? And also there are a few other variations wherein if you want little more smoothing, like moving average itself is smoothing, right? So if you want more smoothing, then what you can do is high plus low by 2, or open or basically HLC by 3 or OHLC by 4, where OHLC is open, high, low, close and volume, right? You can plot on any of the moving average of your choice, right? Similarly, you can do it. Sometimes it's also useful if you had attended the price action session. We had briefly touched upon another moving average, which is on volume or another field. So let's plot a 20 moving average on a volume. So this will tell you that where the volume is increasing. So in this particular case, right, suddenly the volume is increasing out here, right, which tells you, and it is with the negative. So that means that the strength or the direction is pretty much on the lower side, right? Here it has gone above with volume, so market has gone up. So you can not only plot the moving average on OHLC, but also on the volume, which comes down here, right? Slightly not so intuitive, but the volume is also kept here as OHLC, primarily because it's moving average, and that's where we've kept it here, right? So if you need to know where the volume, how to plot moving average on volume, this is the place, right? So apart from this, you can plot moving average on other fields also, right? Other technical indicators. For example, this is RSI, one of the most commonly used indicator. If you want to plot moving average on, if you want to plot a simple moving average on RSI, which is basically moving average on RSI itself. So if you want to plot, let's say 20 moving average, so what you'll see is not only the RSI price, but its moving average, and basically how this crossover has happened. So it's not as simple and as straightforward as price crossing above a moving average, but this is also very useful once you understand this concept of relative strength index, right? You can plot moving average on the indicators also. So let's take an example or two of taking it to giving you some of the real world things. Okay, so what we'll do is we have seen a very simple moving average where we have plotted basically price with this thing, price and moving average. Let's try some other stuff where we want to do it on close price, right? Price field is close, volume, and on volume, right? So what we are plotting is basically cross above. What we are doing is crossing above the 20 SMA on the volume itself. So earlier what we have seen was the price crossing above price moving average. Here in this case, what we are seeing is the volume crossing above its moving average. So you can not only plot price and its moving average, you can also plot volume and its moving average. Similar to this, what you can also do is you can plot moving average on a certain indicator. The example that we saw was RSI, right? So if you want to see right? So what we are doing is basically we are creating a screener where the 14 RSI is crossing above 20 moving average of 14 RSI, right? So looks slightly complex, but once you start using it, or if you know the strategies, if you wish to know, then we have a strategy. We had a session on RSI. You may want to refer to that, which will tell you what this is. So for the simplicity, what we'll do is we'll simply go and show you that where the crossover has happened. So this is where the RSI it's crossing above its 20-day moving average, right? Won't go and explain the concept of RSI moving average because we have done that in greater details in one of the previous sessions. All right. So that was about some of the moving average, right, on indicator and on volume. We have covered all the three important moving averages. Just give me a second. All right. So that's about moving average on this indicator based moving average. So similar to moving average, right? Moving average itself is a very important and a complete tool, but there are certain indicators which are built on top of moving average, right? Which uses moving average as one of its important field. In fact, quite a few, more than about 50% of the technical indicators, they use one or the other moving average to calculate its value. One of the most common ones used is moving average convergence and divergence, MACD, as it's commonly known as, right? It uses a three moving average, 12, 26, 9 as the standard figure, but also you can change to others. Another one is Bollinger Band, which uses 20 SMA, and there's another one which is moving average envelope. As the name itself says, moving average, right? So it definitely uses certain moving average. Without going deeper into these concepts, right, and keeping the focus more on the moving average, we'll skip the details of the other moving average. But what we are trying to tell you here is the moving average has lots and lots of usage. As a standalone moving average, it has usage, plus it's used across various other technical indicators. Okay. Before we go to types of moving average, let me see if there are any comments or any questions at this point of time. Abhishek Singh, thank you very much for mentioning that. Okay, Devesh, there's a feedback. He wants me to slow down. Okay. Siddharth Shah, give option up to 600. We'll try to get that. All right, so that covers almost all. Is there a way to track the slope of a trend like 90 degrees? 90 degrees trend I have not seen any time because it's virtually impossible, right? Because what you do, Mehul, is basically you plot the date axis and the price axis, right? So it can never be there unless you are only on a single candle, right? In a single candle, there are a lot of candlestick patterns that we have seen. The long white bar, Marubozu, those will be 90 degrees. Other than that, 90 degrees is impossible, right? 90 degrees is impossible because time has to move. If the time moves, it can never be 90 degrees, but it can be on a certain angle, right? Which we'll try to see and see if our current product supports what you are looking for. Okay, but it seems like a good requirement what you are talking about. Needs higher trending, right? Yeah. All right, so types of moving average. So as we have briefly seen in the charts, right, that there are quite a few moving average which are there, right? Are all moving average important? The answer is yes, they exist over a period of time. That means it has certain advantages over others. But what we have done is we have about 8 to 10 moving averages in the system, and which are most commonly used. Obviously, anybody can create their own moving average variation, and you can have different moving averages. But the idea is to keep it a little more focused and provide you with information which is generally used by the larger set of trader community. Simple moving average, exponential moving average, weighted moving average, Hull moving average, Kaufman's adaptive moving average, Wilder's. If you remember the name James Wilder, who is also creator of RSI in the session that we created. He also has his moving average, variable moving average, and there are many more moving average, right? So covering all this moving average would consume all the time, which is not worth the session. So what is really important is just to give you overview at least, or make you familiar with some of the important moving averages, and how to use that, and what are the advantages and disadvantages, or what is the right fitment, of a moving average. Okay. Simple moving average, as the name says, it's the simplest of all. So what it does is it's a simple calculation. It is a simple calculation. So for example, P1 is Monday, Tuesday, Wednesday, Thursday, Friday. So the price of last 5 days, Monday to Friday, divided by 5 is 5 simple moving average, right? It's a very simple is a very simple calculation. What it does is, as the name says, it gives equal weight to all the data. That means it will give the equal weight of P1 to P5, where P5 is the latest. This is Friday and this is Monday, right? It gives equal weight to last n days, and it divides it. So it's a very simple average, right? Where is it suitable for? It is suitable for slightly longer duration. Because the response time is slow. So it is best suited for slightly longer duration, right? Long duration trader, as it suggests that it's used for swing trading as well as long-term traders, right? The second one is weighted moving average. So this is a variation. This is variation of simple moving average. What is the purpose of it? It has to give signal faster than this the simple moving average, right? So there's a variation of it wherein it gives higher weight. So as it says that it's weighted moving average, right? Weighted moving average. So it gives higher weight to the most recent data compared to the older data. That means the latest price movement, whatever the latest price movement, gets more weight compared to the older data, right? So the formula is very simple. You don't really need to know the formula, because not only our tool, but there are a lot of tools available available to you which calculates it. And some tools like us gives a lot of these information free of cost also, right? So you don't have to really learn unless you are part of the academic, right? If you're part of academic, then this is the formula, or you can refer to one of the documentation we have in the system, right? Since it is faster than SMA, its response time is better. So it is better suited for day traders and scalpers. The next one is exponential moving average. It is again a variation of the two moving average that we have seen. What is the prime objective of this thing is it gives so this is exponential MA, right? It gives maximum weight. It gives maximum weight to the latest data, right? Most recent data. So similar to weighted moving average, in weighted moving average, the calculation is the oldest price is calculated n times, or the latest price is calculated. So let's say there's a 50 moving average. So latest price is multiplied by 50, and the 50th period is multiplied by 1. So that's how the weight is given. Here in this case, exponential moving average, the latest current price is given a lot more weight compared to the previous ones, and it uses the previous moving average, right? The objective is not to explain you the formula and other things, because it can get a little boring, right? But the idea, what we are trying to do is it tells you that since the weight is more on the current price, it is much closer to the price, right? Since the weight of the latest one is much better, it gives more weight, right? It does not give a lot of weight to the previous ones. It gives weight only to the current price and the previous MA. So it is far more closer to the actual price, right? So it's perfect for day traders, scalpers, swing traders, right? And it is fast. So if you're looking for a shorter duration, then EMA will be a better option. If you're looking for a long-term things, SMA is there, or WMA, right? Similar to, this is a simple example of showing the difference between the three, right? This is a simple price chart. This is where the simple moving average comes in, the blue line. The green line is weighted moving average. If you see, this is far more closer to, this responds much more faster compared to the blue line, right? This is weighted moving average because it gives more weight to the latest period. And this is the exponential moving average. Now, if you see, with the change of the trend, right, the first one to respond is the exponential moving average. Then the weighted moving average starts responding, and then last is the simple moving average, which responds, right? So depending on what you are looking for, the faster the indicator responds, the more chances of fake signals, right? So everything has a pros and cons. So depending on what your trading style is, or your trading duration or profile is, you can choose one of the three moving average, right? The slower, the more reliable, and less fake breakouts and breakdowns. We'll understand what fake breakout and breakdown is in a short while. But this is the typical variation of the three moving average. Let's also see in one of the charts. Let's draw a okay, let's draw three moving average. So we have drawn simple, exponential, and weighted moving average. See, we have drawn the three moving averages. So the red line, the red line is simple moving average. It's the farthest from the price. If you see on a good trending market, right, it's the farthest from the price. And this one, which is the basically the weighted moving average, is getting much closer in this particular case, right? It's getting much closer, and this is the EMA. So all the three moving average, you can plot it and see where things are, right? So generally you'll see that there's a lot of lag in the simple moving average, which is the red one. And these two moving average, depending on the price and depending on the moment, either exponential can be closer, because both of them, exponential as well as weighted, give a lot of weight to the latest prices, right? Depending on the kind of setup, one can be closer to the other one, but generally EMA will give you better response, right? So these are three examples of three moving average. Okay, all right. So similar to so this is one of the example which it says, right, which our team has brought up. If you see in a nice trending market, if you see that the first moving average, when the price goes down, the first moving average which goes flattish is the exponential, followed by weighted moving average, and then followed by a simple moving average. So if you're looking for really short-term moves and catch short-term moves, then you have to look for either WMA or EMA. Rather than SMA, because in SMA you may have lost a lot of good moves, right? The first one to cross below is WMA, right? But the first one to get flattish or going down is the EMA. So depending on what you're looking, the trading profile and other things, you can choose one of the moving average, right? For simple moving average, it responds much slower compared to the other one. Okay. So now these are not the only three moving average which is very actively used by the analysts. These are the three most common ones. There are a few other ones which are there also there in the system, right? Hull moving average, Gamma, VMA, and Wilder smoothing moving average. There are quite a few moving averages, but these are much more commonly used, right? Now compared to each moving average has its own style, right? The way it is built or the way it is calculated is different than others, and it serves a specific purpose, right? Like weighted and exponential moving average gives more weight to the latest one. Where Hull comes in, right? It was created by Alan Hull. What it does is basically its prime focus. Its prime focus is to eliminate the lag, right? When it is eliminating the lag, what lag means is the gap between the moving average, right? Between the price and the moving average is the lag, right? How does it react? So when we look at things, right, all these moving average has a lag. Each one of them has a certain lag, right? So for a very dynamic market or for a short-term movement, right, what a good moving average is where the lag is much lower. So Alan Hull created a moving average where it tries to eliminate the lag, right, and which is much more faster. So let's try to plot another moving average out here, which is Hull. Which one we were looking at? Hull, right? We are looking at the Hull moving average. So looking at the hull, right, and give it a color which is okay. This color is fine, right? So when you look at this, so if you see hull moving average is far more closer to the price, right? And if you see, this is also giving good kind of resistance to the price, right? So it's responding and reacting much faster than any other moving average. So if you're looking at the very fast response time, then perhaps you should be looking at hull moving average. Similar to that, there are other moving average like Gamma, created by Perry Kaufman. What it tries to do is its speciality. Its speciality is basically it incorporates the volatility of the market, right? It incorporates the volatility of the market. It has a certain formula. Don't need to understand it, but it factors in the volatility of market. Now, if the price is sideways, then you will see Gamma is flattish line, much faster than others, right? So in a volatile market, this one will be a good fit. Same as variable moving average will be a good fit when the volatility is there. So if you are looking at very fast response time, then look for a hull moving average. Internally it uses WMA, right? So Gamma uses volatility, so is variable moving average, and then there are other moving averages and along with the formula. So depending on what you are looking for, depending on the period, you can choose one of the moving average, negligible lag, or incorporating market volatility, and a few others, right? We'll have an example or two for each of the common moving averages, right? So now what we are covering is about some of the key strategies using moving average. Before we get there, let me see if there are any comments or something. All right. Do we have a screener of moving average and option? Option, we don't have it. Yes, option chain analysis not at this moment live. We have option chain, which does include quite rich set of features like Greeks, Gamma, Delta, Vega, Rho, but not the real time. We are looking to get option chain also real time. How do you set target based on moving average strategy to get maximum gains? We'll cover that in some of the strategies. What is position sizing? How about position sizing? Not sure if I understood. You're looking at how much of position should you take? Then obviously you are the best judge, right? Depending on what your capital, what your risk appetite is. Thanks, TD, for mentioning that. For the can we find on a particular day and particular time any crossover happen? Yeah, we'll cover that. All right. Then Vishik Singh, would it be possible for me to receive the deck? We'll see if the quality of the presentation is good. We'll share this thing. Also, since you have mentioned here, what we do is basically, if you remember our last session, right? We had a session on candlestick. What we do is we try to incorporate best of the things from there into this, right? All the key important stuff. Like in the previous sessions on candlestick, we had a lot of charts, the reliability and other things we put in the tutorial. So stay tuned to the tutorials.topstockresearch.com. That's where we'll put all those important content in one or the other form over here, right? So all the important or all the candlestick patterns that we covered last time, about 70 odd patterns, right? We have created certain things, and then for some of them we already have a write-up. In the write-up, you'll not only get the images, but also you'll get a lot more deeper strategies compared to this, right? So for the time being, we'll try to upload the video if we can. Otherwise, stay tuned to this place. You'll have all those information coming out here, right? One of the key things for all the hard work that we do is the motivation that we get, and motivation comes in form of your liking and subscribing. So if you guys like any of the stuff that we present, then please do like and subscribe, share with your friends, right? That will be the oxygen for us to produce more and better quality content. Okay, so what else we have is, okay, we'll cover some strategies. How to use all these for day trading, we'll try to cover them also. All right, so moving average strategies, right? First is moving average EOD and intraday strategies. We'll cover certain crossovers. One of you have mentioned about crossovers, golden, death, and few other crossovers. Guppy moving average trending up. That's what I think, Mehul, you were referring to, moving average. Not sure if it fits into your this thing of 90 degree, but that seems like a very, very interesting and important this thing. Then so remember guys, moving average provides support and resistance, dynamic support and resistance. So sometimes price bounces back from this. So that's again a good strategy. We have a screener for this. And sometimes there are fake breakouts and breakdowns of moving average, right? Now, finding these things are extremely complex, going chart by chart and other things. So we have a screener which will help you to reduce the time for this fake breakout and breakdowns. Then we have quite a few other moving average strategies. So in a very, very high level, the important ones are the crossovers, trending, bouncing from support resistance, breakout breakdowns, and some of the divergence and convergence that we discussed a while back. Right? So let's get into some of the strategies. Right? Now, basically, when the price crosses a certain moving average, right, it's considered to be giving a certain signal, which we have briefly covered, right? So in the example that we have a 20-day moving average. When the price crosses above 20-day moving average, it's a start of a swing. It's good for swing trading, right? Similarly, if it crosses below this, then that could be a good entry point for swing trading. Remember guys, in one of the slides that we have had almost towards the start, crossover is one thing where we shown that the reliability is X. You should not rely only on one crossover, right? You should look at some of the other things, as we have seen in one of the slides. Remember that crossover, then the gap is widening, and in some of the previous sessions that we have had, for example RSI or in the candlestick or price action, where we were looking at some of the other indicators, right? So this even though this is a good strategy, but go with slight caution. So the price is crossing above a certain moving average, right? Now what it is a downtrend, and it has crossed over. Now if you see, there are quite a few things which are there, right? First of all, it's a very big green bar, right? Crossing above is one. It's a good green bar, good volume, and it's almost like at a near swing high, right? If you see at the close price, it's near at this level, right? The previous important level. So either you can enter here or just wait for one more day and get an entry out here, right? So moving average, once the price crosses a certain moving average, you look at the previous basically setup. If there are good signals out here, then this will be a good strategy, right? If you also see, there's a double bottom being formed out here, right? Double bottom is there, good volume, sort of a small gap up, lot of consolidation, right? Lot of dojis or very, very small candles, right? Last 4-5 candles are very, very small candles. Compared to that, this is bigger candle. So what you need to do is not only looking at the moving average crossover, but also look at the setup where this particular crossover is happening. If rest of the setup is there, moving average can act as a very good starting filter point. Now, looking at the charts, when we see that the price is crossing above a certain moving average, price crossing above exponential, in the example that we have had, when we look at the prices crossing above moving average, right? The price is crossing above a certain moving average. You have to look at some of the setup here. Sort of a rough or very, very loose double bottom kind of a pattern is here. The price fell very sharply with good volumes out here, sort of stabilizing. If you see other good setups, you might want to add a candlestick pattern. See, there's a good gap up out here, right? The previous levels are broken, sort of a double bottom, right? So what you should be looking at is multiple setups. Over here again, sort of a double bottom, right? Look at the setup. It is flattish moving average, right? It is a flattish moving average, not much greater a signal compared to the other one, right? Not greater a signal. So you should also not immediate support or resistance level is broken, or volume is also not that significantly high, right? So tread with caution, right? It's not simple moving average, right? Trade with caution. Over here, you'll see that there's a nice pattern being formed out here, right? Nice pattern being formed out here. There are 2 or 3 clear gap ups, right? And then moving average is crossing above. Just see if there's a good volume in the next trading session. That should give you better confidence, right? Trade with stop loss. So this is how you'll typically look at this. This again does not look like a great one, but if there's a starting point which is above this point, if there's a gap up over here, you'll not only see the moving average, but you'll also see a island reversal, right? You'll also see an island reversal. So that's again a candlestick pattern which we covered in a couple of weeks back session, right? So what you should not be looking only at one thing, but as a combination of few other stuff also. Like in the example which my team has brought up, is like here they are showing volume and also the previous levels, right? Another example just opposite of that, it was in uptrend. Then there are 2 big big red candles, right? Very big red candles, and that this one is sort of a bullish engulfing at the top. The volume is good. Now this is a better example, right? You have multiple things which are working for you, right? Aggressive traders could have entered sometime in the day itself. Relatively conservative traders would enter sometime here, right? When the price is below this level. Intraday strategies. So basically for intraday, what you can do is, this is an intraday period between 5th and 6th Feb. When the price is crossing above 5, 18 and 13 moving average, exponential moving average, in this case, it's crossing above 5, 13 and 18 moving average. All the 3 moving averages are pretty close. Then that will be a good entry point. And the exit point is where it has breached the 3 level or at the end of the trade. If you are doing an intraday trade, then obviously you should square your position at the end of the day. So this is where the position was, basically it was breaching. If you had used 1 moving average, then there was some breach here, right? If you just used 5 moving average, there were few breaches out here. But it's if you're looking at the 3 moving average, the combination of 5, 18 and 13, it is it's giving much better signal, right? So this would be a good strategy. When the price crosses above all the 3 moving averages together, if you see the with good volume also, then that'll be a good entry point, right? Look at all the signals which you can get, either a candlestick pattern or some of the other signals, right, along with these things. So this will be a good entry point. Now, basically, why 5, 8 and 13, right? I'll try to explain you why these are extremely shorter moving average and when we are trying to do a intraday trade, right? So let's plot a simple chart. For example, ACC, let's just take this one, ACC. This one is, okay, let's plot, okay, EMA 20, okay, that's okay. Let's plot EMA 200 and EMA 5. EMA 5, right? So what we have plotted are 3 different moving average, right? ACC is not a great example because it has seen a lot of volatility because of some of the news which has come out. But without worrying about all those things, right? If you see 200-day moving average, it reacts much slower. If you see, it's almost flattish. It is almost flattish, whereas it has given a huge trend up here, right? And then downtrend. So the price movement is series of trend, right? Short-term trend. Exponential moving average doesn't really care anything about it, right? So it's for long-term investors. For slightly swing trading kind of traders, you see that 20 moving average is responding much faster than 200-day moving average. So it's for the short-term users. The shorter the moving average, the closer it is to the price, because it considers the nearest price value, right? It considers last 5 days price, whereas this will consider last 20 days price. This will consider last 200-day price. So even though there was a movement up here, long-term investors, they hardly care for the small movements, right? So they can still work on 200-day moving average. They can still work for 200-day moving average, and then they can do it. Now, removing some of the other moving average, you'll see that even for 200-day moving average, right, there were small breaches here. These are generally called fake breakouts. So you should also be looking at some of the fake breakouts that is it a fake breakout, or is there a proper confirmation? If you're looking at long moving average, then you should definitely look for the confirmation, right? For next couple of candles where the movement is. So these are fake moving average. Again, it's sort of bouncing back from that level. Again, there was a small breach out here, and then eventually it breached and then it came down. Of course, this particular case is a slightly different case. Randomly we took ACC. It was because of big news, but once it came down, and it's like much lower, right? This is the place where you should exit the trade. All right. So so basically the deviation why we had is we were using very small moving average because we were looking at the intraday period, right? 5, 18 and 13 moving average is a good strategy for your trades. Just opposite of that is bearish 5, 8 and 13. That's just opposite of that. If you feel that you can fine tune or you can work with other moving average, let's say 4, 7 or 11 or whatever, right? Feel free to use them, right? Whatever works for you, whatever really works for you. For the stock, sometimes certain moving average or certain indicators work better for a stock compared to other stocks, right? Or even markets. Certain moving average works better for a certain market and market condition. So feel free to tweak and tune these moving averages, right, according to your need. Now, moving average strategies. One of the most popular moving average strategy is golden crossover and death crossover. They are just opposite to each other. Golden crossover in general is said that when a shorter moving average crosses above a longer moving average, right? But generally it is considered as 50 and 200-day simple moving average, right? And then there are double moving average crossover and triple moving average crossover. We'll see what those are. So if you're looking at long term, then what you should be looking at is whenever a smaller moving average for golden crossover, golden cross, it is 50 moving average crossing above 200 moving average. This is the point where the entry comes in, and especially when you're looking at the long term, very long term period, right? This is the place where you should be entering. In TSR, we have a ready screener for it. Go to pre-screen, technicals. In the moving average, you have $50 crossing above 200-day moving average. So in the blue chip, you have UPL, right? That's where the 50 is crossing above that. If we increase the scope to a higher this thing, again, that's just the UPL is the one which is showing the results, right? Where the two moving averages crossed above 50 and 200. Not a very clean crossover, not a very clean crossover, but that's what it is. Right? So if you see that the 200-day moving average, right, there was a positive crossover, but 200-day moving average was almost flattish. This is also, it was almost flattish. So moving average also, as we have seen, right, it tends to give you the direction of the stock movement, right? So if it is sideways market, it tries to get flattish, right? If it is trending, it's going up well, right? So from longer duration perspective, it is still flattish. If you see the UPL, it is pretty much flattish because the market is sideways, right? Market is on the sideways. You just look at 200-day moving average, it's very flattish, right? It's hardly moving, right? So that also gives you a very good idea that where the direction, long-term direction of the stock is. It's very flattish. Now this is where it is rising because there was a good price movement up here, right? So this is where near crossover, and then both are rising, shorter and longer, with the gap increasing. So that means the trend is also increasing out here, right? Just a small deviation I thought of mentioning along with the 50 and 200-day moving average. This is one way of doing it. The second way is going to custom screener, DIY screener, do it yourself. Go to moving average strategies, add 50 crossing above 200, run it, right? You'll find the same stock, right? Here the advantage is you can set any moving average of your choice. Okay, so that's about golden crossover. Its applicability, especially in long-term market, right? Long-term, and this is really good. right? Since a lot of analysts across the globe also looks at it. When I say globe, it definitely includes FIAs and DIAs, right? So when such crossover happens, right, a lot of position also gets added to this place. You'll see certain analysts when they come on TV, or certain research reports which come out, they say that it has crossed above 200-day moving average, or the golden cross has happened. So a lot of eyes are on this particular thing. That's why, even though it is not technically very likely to move, but since there's so much of pressure in looking at it and reacting to it, it artificially also adds a lot more weight to that, right? Just opposite of that is death cross, wherein 50 moving average crosses below 200 moving average, right? Just opposite of the golden cross. Right, so just a variation of that, just a variation of that is where two moving average are crossing. When a shorter moving average is crossing a bigger moving average, right? Crossing down is a bearish crossover, and this will be just a bullish crossover, right? Very simple to do that screening. Just change the moving average of your choice. So in this case, what we are doing is changing it to 20, right? Coal India. Right? So this is where the crossover is happening, right? So you'll get those kind of signals very clearly, right? In a trending market, that will work really well. In a sideways market, you'll get a lot of choppiness, right? Also, what we'll do is we'll just go to Coal India and look at some of the moving averages which we have in the system, right? Pre-created view, go to technicals, and we go to all moving average, right? So if you see each moving average, simple moving average crossovers, exponential, they are crossovers, and they are a weighted moving average, and they are crossovers, right? So for each moving average, if you're just going to a stock and doing a little more analysis on the moving average, plotting all those moving averages relatively pain to you, what you can do is you just look at here that from your perspective, which moving average is important, and where is it vis-a-vis the basic stock. So if you see out here, if you see out here, this is dark red, right? 20 and 50 moving average. So what it tells you is 20 and 50 moving average, 20 and 50 EMA, right? No, simple. 20 and 50 simple moving average. Simple moving average. If you see that 20 is far below 50, right? So it's also widening. So that's why if you see here, it is a strong bearish, right? It's trending down. 50 moving average is also trending down, right? So that's why it's marked as red. Now, if you see, there are certain green, certain red. The darker the green, the better the strength is. The milder the green is like slightly mild bullish. It's written over here. And there's also a special signal which is out here. It's called whipsaw. Let's see what this means. When you look at this thing, right? So there are a lot of crossovers which are happening at this point of time. 1, 2, 3, 4, 5, right? So it's not giving very clear signal. That's why it's giving you like a alert signal, right? Similarly, in 200-day moving average, you'll have the same thing. There are a lot of crossovers are happening here and there, right? So that's where you should trade with little more caution. So this is about moving average on a particular stock. If you find that there are too many things which are not required, you are just looking at simple moving average. So you just change it to simple moving average. This will show you only simple moving average, right? Whatever is important to you, you just look at that. Or just looking at WMA, this is here. There's another way where you can get this sort of information. You can go to customized view. In the customized view, let's go into technicals. In the technicals, what you can do is you can plot any moving average of your choice. So here there are certain moving averages which are available to you. What you can do is you can change whatever is there so that you can remain. If you are long term, you'll be looking at maybe 50, 100. So if you are a short term then you'll be looking at a smaller moving average. So these are certain pre-built moving averages available to you. You can choose what you are interested in, right? That's one way of doing it. There's another way where you can do is you can plot your own moving average, right? For example, so add a moving average. You choose any moving average of your choice. Let's say you're looking at 49 moving average, add 49, right? So 49 automatically gets added, right? And where it is vis-a-vis price and what place it is in when the crossover has happened, that set of information is here. So this tool will help you to focus on the moving averages that you are more interested in rather than looking at all the information. Now, let's say you are looking only at moving average, or moving average is your prime thing. What you can do is you can go here in the tab, in the tick, sorry. You can remove what you are not interested in, right? You can remove what you are not interested in, and that's how you can get all those things. Save settings, and then you'll have only those things which are okay. So remove it. What you are not interested, remove permanently. That goes away, right? So you can have complete focus on the moving average, the choice of moving average, and where it is placed and how it is placed. Okay, along with the chart, and each one what you plot is comes along with the moving average of your choice out here, right? So that's about stock moving average. Triple moving average, we have an example wherein the example that the team has brought up is basically the 3 moving average, 12, 25, and what's the third one, Mayur? 30, right? 3 moving average, 12, 25. So the example which we saw in the previous slide also, right? So this is where the price is crossing below the 3 moving average. It's coming out with a good red bar. So that will be a good bearish crossover, right? So in the previous sessions, what we did is we covered 2 moving average. Here we have added the 3rd moving average primarily for more of a swing trading or a slightly mid-term trading, right? In the previous one, where we added 8, 12, and 8, 13, and I think 5, 8, and 13, right? That was for intraday. For slightly longer period, what you can do is 12, 25, 30 moving average. You see that all the 3 moving average are roughly crossing along with a big red bar, and it's coming down. All right. Any questions so far? Let me see. Thanks, Abhishek, for mentioning. Much appreciated. It gives us a lot of motivation of all the good comments that keep coming. Sir, all is available for membership. So Ravi, it is available. Moving average crossover is available. You might want to connect with us about the plan that you should be looking at and what your requirements are. We have plans starting from very low price to a very, very reasonable price. So depending on what your requirement is, we'll try to give you the best thing which works. Explain with Haikinashi. Asif, my friend, you're back. Great. Explain with Haikinashi candle. All the lines are difficult to differentiate between price and moving average. Yeah, you're right. So we'll try to get candlestick as much as we can. Hindi, please. Samarthas, this session we'll have it in English. We'll have another session on Hindi. Perhaps that's the time you might want to join us again. We'll cover those session in Hindi, right? Sir, please make a video on demand and supply. Yes, we will make, right? Definitely. That's a good suggestion. Do you provide mentorship as well? I'm keen to be your mentee. I'd like to have you as my mentee, Abhishek, but our core focus is to give you better quality tools rather than, in terms of the training. We haven't started any kind of training, and one-on-one training would be slightly more challenging at this point of time, right? But we'll provide good quality tools. We'll provide the core concepts as we have been doing it in this session. one-on-one session will be a little more complex. Clearly not at this point of time. Our idea is to bring lot more features, and one or two more features which we are about to show it to you. You'll be pretty much excited to see, wow, that looks really good, right? We are completely trying to break the barriers where some of the other traditional tools are. Okay, now the next one is Guppy moving average strategies. So Mr. Guppy, Daryl Guppy, he created a strategy wherein he used combination of shorter moving average and combination of larger moving average crossovers, and that seems to be a very good strategy. It works for a lot of I've heard a lot of traders use it, and they use it pretty successfully, right? So what it does is it has combination of shorter moving average as one range, and which are basically between 3 to 15, and a longer moving average which is between 30 to 60 moving averages, right? And how they cross each other gives the signal, right? So let's look at what those moving averages are and how these are, right? So first is shorter moving average, which is plotted in green. As it is shorter, they're definitely closer to the price. They go in one cluster, and then they have you have a longer moving average, right? Which is, as it is longer, it is away from price, not only from price, but also slightly away from longer moving average. Now what it does is basically it tells you that where that particular thing is, right? Now if you're looking at longer term, then you see that all the long term moving averages are going up, right? All the long term moving averages are going up, and the short term moving averages are here, right? So the long term moving average, if there's a widening, that's a good signal. If there's a widening, there's a good signal. This is the level where it normally gets breached, right? So unless this cluster is breached, you are in the green position, right? You are in the green position, right? Quite a lot of materials are available on internet on this Guppy moving average. Going too deep into Guppy moving average in this session would be slightly beyond the scope. We might want to have a separate session of plotting a lot of these stuff, but for your sake, the shorter moving averages and longer moving averages are plotted this way, and you'll clearly see the trend, right, of where it is. Okay, so the prices where this set will be there can be acting as like a good support level or good entry points, right? So one entry point is here, the exit is somewhere if it were to breach below this, right? Similarly, just opposite of that, bearish crossover is here. So all the shorter moving average there's a bearish crossover out here, right? And the shorter moving averages are crossing below the longer moving average. So that's the entry point, and the exit point somewhere coming around this place, right? There will be certain places where it will be taking support or resistance in this case, right? So these are the points where you'll be taking certain support or adding more of the short position or selling your positions, right? Because the market might want to go down, might go down here, right? So we may have a separate session, as we have said that we'll try to have 2 sessions a month on all the core concepts. The idea here is to give you the broader moving average concepts, expose you to certain key or important strategies. So this is one of the strategies, right, where the shorter moving average crosses the cluster of shorter moving average crosses the cluster of larger moving average, right? MA trending up and MA trending down strategies, right? 20-day moving average trending up. I think this is something which you all were also asking for, right? So as we have seen, if the price is trending up, right, then eventually the moving average will also trend up, right? Eventually moving average will also trend up. If the price is not trending up, then moving average will, in this particular case, if you see, it has gone flattish, right? If the price is trending up, moving average is also trending up. Now we have a screener for this. We go to a DIY screener, custom screener, DIY screener. In the DIY screener, you have go to moving average and look for trending moving average. For example, if you're looking for, let's say, a 15 moving average trending up for, let's say, 30 ticks, right? So on close price, right? You can do it on other prices also. Okay. No stock in blue chip. Let's increase the scope to NSE 500. So there are about 6 stocks which are trending for a 15-day moving average. When you look at this, see, if you see, the moving average is clearly trending up, right? So moving average is clearly trending up. In this case, along with price. In the previous one, there were certain breakdowns, right? So in this example, this is much better, right? This one, again, it's trending up. There are certain support which moving average has taken, right? Now, if you were to find that a screener where you find all those supports, we have a screener for that also, which will show in a short while, right? So this particular screener will tell you, where the price is trending up. Along with that, what you should be doing is, like in this particular example, right? It was trending up, but the price is currently below the moving average, right? So not a very good one. So to add it better, price is above the same moving average, right? Price is above the same moving average. So in that case, the APL Apollo tube, right, which was a bad example, will be eliminated. Right? See, there are 4 stocks, right? So you'll get slightly better quality stocks with this one. So mix and match different tools out here. In this case, there was a fake breakdown, right? In this case, there was a fake breakdown. We'll understand what those are, right? Thanks to one of our users who encouraged us to get fake breakdown. I think it was Glenn, if I'm not wrong, Kuldeep. Yeah. Right. So he encouraged us to get that, right? We have included that in yesterday's release, right? So this is again a nicely trending. Plenty of support is being taken, right? So if it comes down here, lower level, this is where the buy on dips would come in, unless this particular period is line is breached, right? And look at the other signals, right? If you look at the candles out here, right? See, the nice good candles are coming out here, right? Nice good candles are coming out here. So that should also encourage you that the trend is nice. And there's a gap up at the uptrend, which is a very, very good signal, right? And also with good volumes and everything, is a lot of good volumes are coming here. If you look at Bollinger Band, I'm sure it has breached multiple times, which it has done, right? So going from one indicator or the other indicator, all will tend to give you pretty similar results, right? But if you are the key is to be good at least 1 or 2, right? And then use rest of them as more of a confirmation, right? Again, looking at the other ones, right? So all these stocks are there where the moving average itself is trending up, right? Similarly, we have a trending down. Needless to show you, but just giving a very simple example of moving average. So this is trending up, right? Then trending up including bullish crossovers only. So if you were to do this one, there are other variations of it. Okay, there's no stock. Maybe let's reduce the time. Right, no stocks. Let's change it to maybe 20 moving average. Yeah, right. So what we have done is, first was pure trending up, right? So what we've done is includes bullish crossover only in the trending up. So when you look at this, you'll see that there's no bearish crossover. I think we added 2 conditions, right? We have added 2 conditions. Okay, so let's see the Phenolix cable, right? So only it is trending up and there's only bullish crossover in last 20 ticks, no bearish crossover. So the one example which got eliminated in the previous one, right? If we had used, instead of just trending up, if we had used only bullish crossover, then that would have given us the results, right? Trending up with no crossovers. So what it means is it's just trending up and there's no crossover, right? So this will be good examples, because in last 20 ticks there's no crossover and both are trending up. Price and this thing is trending up, right? So if you see, so this will be like any point where it is close to this, right? You should be looking to accumulate more because the trend is up and there's no crossover, but the price and this thing both are trending up. Right? So this could be a good entry point. If it were to retrace from this level, then this will be a good entry point. This was somewhere it has given a point going up, good entry point. Again, this is sort of retracing. This will be a good entry point, right? Similar to that, you have just opposite of it. which is for the bearish one, which I'll skip it and I'll leave it to you for your own analysis and research. All right. So trending down we have seen, trending up we have seen. Now the third one is basically we have seen the examples, right, where the price is taking support and all these things, right? But looking at the chart one by one is very, very tedious. It's humanly impossible, right? So what we try to do is we try to create a screener for this, where it will see that how many support it has taken. So in the example that we have, or the team has taken, right, is price is taking support of a 50 moving average and a pullback or resistance. So the example that we have is basically 50 moving average, where the price is coming very close to 50 moving average and retracing, coming close to moving average, retracing at each of the point, right? At each of the point, apart from this thing, you might want to look at the candlesticks things here, right, where it is retracing, right? There's a gap up here, then there's a gap up here, sort of an evening star kind of a pattern is there, right? So a nice gap up is here, right? So after this crossover, it has, whenever it's come very close to this, you see a gap up. That should give you better confidence, right? Again, over here, there's a good volume where it is trending up, right? That should give you better confidence that that trend is intact, trend is intact, trend is intact. Again, this is where it has given some sort of support, right? Price has given support. So that should give you better confidence. Along with that, just look at the other things which we have seen in some of the previous sessions in the candlestick, or even some of the other trend lines, right? If you draw a trend line would also be very, very similar to this, right? Along with the moving average, trend line is there. So try to use the knowledge that we have gained in the previous sessions along with the moving average to give better confidence. This alone itself is a complete indicator because it's giving good bounce. But if it is forming a certain good pattern, right, gap ups or big candles, good volumes, that should give you better confidence in getting into the trade. Just opposite of that is moving average acting as resistance, right? Another one, rising SMA coming down, bouncing at that level, right? Then looking at this is sort of morning star, right, variation. This is a good green candle, right, and followed by a gap up, right? So look at things where it would be. Now this is the place where it has come close, doji, right, to be so basically it's very close to support line, and a small doji is there. The movement is pretty strong down here, right? Movement is pretty strong down here. A small doji. Once it's breached, it's clearly below that level, right? So look at some of the other aspects also. Just not only the moving average crossover. Remember, guys, the confirmation that we have had in one of the slides. Moving average is just crossover is about 50%. If you add more and more mix, that should give you better confidence, right? So use the tools, use the learnings of the system, and that will give you better quality results, or make your trades more profitable than more loss making, right? Or less stop losses. Now time to see in the real world. So again, where do you go? Go custom screener, DIY. In the DIY, go to moving average tab. In the moving average, what we are looking is bouncing from a certain moving average, right? So we have so basically what you can do is there are certain formulas which you can apply. That for example, if you are looking for moving average support on a 50 tick on NSE 500 stock on daily tick, right? So what you can do is just say that 50, and there are certain fine tunings required here, right? How many times the bounce back has happened, within what percentage the bounce has happened, and within last how many ticks, right? You can go all the way back up to 50 ticks. So when you look at this, there are a few examples which are coming down here, right? So it is bounced from this level. Again, it is bounced from this level, right? So there are certain examples where it is bouncing from that level, right? Bouncing from that level, whatever period you have set, it is bouncing from that level. So similarly, it is bouncing from that level, right? So the tool will help you to filter out these stocks which are bouncing from that level, Similarly, if you change it to resistance, looking at the resistance, it's retracing from that levels. So you see quite a few stocks are there. So see, it's trying to go there very close. It has come down. So same way, it is retracing from that level, retracing from that level, retracing from that level, right? Now in this case, you would want to eliminate this, right? Sometimes you may want to get in, sometimes you may want to eliminate these things, right? How do you eliminate that? It's already pretty far, right? So what you can do is add another one, price within whatever percentage you are looking for, right? Let's say 2% of 50 SMA, right? When you do this, what you are doing is number of records that we see is about 25, right? What we have done is we are looking for something which has bounced, number one, and also very close to that level, right? So when you search this, instead of 25, you get 8 records. Now it has bounced and it's very close to that level, right? So there's a chance of you selling or getting out of the stock, or if you are daredevil, you can short also, right? Close to that level, right? So these are certain points where you may want to prepare yourself, right? That you may want to take a position. Now, if you look at this, it's giving pretty good reacting very good to this moving average, right? In this particular case, there was a small basically breach, right? This is typically called as a fake breakout and fake breakdown, right? We'll come to that, what fake breakout and breakdown is, right? So with me on this, guys, use all the tools, and what we are doing is we're just adding these two things, right? Moving average. Similarly, you can add any other tools also along with this thing, right? So there are lots and lots of other indicators which are available here, right? Price action or candlestick and other things. You can mix and match any of these things along with this moving average. Just to keep it simple, I'm just using the moving average because in some of the sessions that we have had, we have covered mixing of multiple indicators. Okay, so this was about moving average. I think we have created certain moving average, which is certain indicators or a certain fine tuning, right? So what we have done over here is basically we have chosen certain moving average at random. We have just taken one and we have used some of the defaults, right? How many times it has bounced back, within what percentage range it is, and within last how many ticks, right? So one of the strategy which we built after yesterday's trading session is basically bouncing back from a support level, right? So in this example, what we have here is basically 100-day moving average, and it's bouncing back in last 20 ticks, right? So when we look at this, certain examples that we have is, let's say HCL, right? You see that it's reacting pretty well back here, right? It's bouncing from this level, right? Another example that we have is it's this L&T Finance, right? So if you look at this thing, right, it's reacting very well. So it, first of all, the price is in uptrend, and then when you see the moving average is also in uptrend. Now if you just look at these two things, well and good, right? But if you see that there's some sort of after this thing, the plateau is happening. So this level, breaching of this level will become increasingly crucial. You see that the lower levels are going up. So if you are familiar with some other patterns, it's a wild variation of a ascending triangle pattern as well, right? When you look at this, right, wild variation of ascending triangle, whichever way you want to draw it, right? So along with the support which this moving average is giving, right, also another pattern is being formed. If it were to breach above this level, so second thing what you can mimics, first of all, there are multiple support levels, right? This would have been a good case, but if you see that it's not making a higher high, higher lows, right? It's making similar highs and higher lows, right? So what you should be looking at is, you should be, if we will have a session on this chart patterns where we'll cover candlestick and other patterns, right? So this is sort of forming that particular pattern and it's giving support. So just remove those additional things, right? Reduce the noise. This is nicely giving that kind of support, multiple supports on this particular moving average, right? So the screener will help you to filter that out. Similarly, looking at the resistance level, we have what we have here is basically 50 moving average, 2 and 1, which is very similar to what we saw earlier, right? So it's giving nice resistance multiple times, right? So right, in last 20 ticks it's giving some sort of good resistance, right? Quite a few one GMR if we see, right? So it's reacting very closely with that, right? Look at some of the other setup, right? This will give you a very good screening facility, right? Not a very common one, not a very common kind of a screener which we have is available in a lot of tools, right? So since it is in our tool, guys, you have taken a subscription. Make full use of it. Make full use of it. It's very powerful, right? Let's move on. Before we move on to the next important one, let's see if there's any question or comment. Intraday strategies will explain. Didi, Arjun, do we have a screener of moving average and options? We have discussed that. Also, please include show hide option with format delete option for all indicator added to the chart. Also include show hide option along with the format. Okay, Muralidharan will connect with you, or maybe with you sometime to see what exactly that is. Looking at that thing, it does not look very difficult, but it's slightly away from moving average, so we'll skip that for a moment, but we'll definitely try to get that. Do we have a screener of moving average and option? We have discussed that. Option, we don't have it along with moving average. In the most examples, the price is either reached top or went down. Kindly explain the proper entry points. Suppose today we are analyzing what stock. Okay, Didi, we'll try to get there. Okay, remind me of this question if we missed this one, right? So going into the next one, another very interesting one, right? Another very interesting one is continuing with that example, right? Breakdown, it's giving you that kind of so in this example, or maybe in the previous example also, right? What we have seen is, along with this moving average support, right? What it's a nice a small variation of Twizzler kind of a pattern. If you change it to 2-day pattern, right? So this is 1 day, right? If you change it to 2-day, it's a nice bottom Twizzler. This is a good morning star, right? Forming almost at the same point, right? And in this case, it's also bouncing at the similar previous low, right? So look at not only one thing, but look at some of the multiple things, multiple indicators that will give you better confidence. Similar example which team has brought up is basically this example. This is sort of a good Twizzler, again a good Twizzler, right? For you to and so here entry is short, right? Short entry. Don't confuse with buying the stock. This is basically the reverse, right? So resistance. So this is for short entry. This is again a short entry, sort of a good Twizzler out here, right? With followed by a gap down, right? Things like that. This is where you can exit because the trend is changing. Again, the trend is sort of changing out here, right? So this is where you can exit this position. Now, next very important thing is not every crossover will give you 100% accurate result, right? Sometimes what happens is the crossovers are fake, right? So what is fake crossover? What is fake crossover? The price has breached the moving average for a very short period, and then it has retraced back, right? So in a way, it has given enough importance to the moving average as either support or resistance. It has honored it, but briefly it has breached, right? But still sort of honoring it, right? So let's see certain examples of a false breakout, right? In this particular case, it has briefly breached here and then came down, right? Another example which we have here is it has briefly breached here and then it has gone up, right? That means trend is still intact. So if you see there's a good signal out here, it's formed sort of a morning star, gap up is there, big green candle is there, then you can continue out here, right? So a few different strategies. What you can do is either you use this as a stop loss or you use a point slightly below this as your stop loss, right? Now, how do you find these false breakout? what we have done is we have tried to create a screener for you. You tell us whether it meets your requirements. So over here you have this fake breakout, right? So in this example, let's go with the default setting and let's see with the 50 moving average, right? Run it. You'll see that there are 4 or 5 stocks which are there where there's a fake breakout. Now what fake breakout is, if you look at the candlestick, right? If you see okay, rather let's look at line first and then we'll go to candlestick. If you're just looking at the close price, it has briefly breached there, came down, briefly breached there, came down. Twice it has given a false breakout, right? And then it has come down. Now what it means is it is still honoring it, but on that particular day or that trading session, right, it has somehow got above or below that either support or resistance line, right? So these are false breakout and breakdown. Now these are very important because it does happen if you simply do automatic trading, right? This is where you'll get here, this is where you'll exit, right? If you were to wait for a proper signal that it's above there, so aggressive traders would obviously lose money. More conservative traders will use this as an opportunity. The fake breakout should give them better confidence. Fake breakout should give them better confidence that this line is still honored, right? Or as a resistance level. Similarly, you can do as a breakdown, right? So if you look at it, right? So this is a fake breakdown, right? Fake breakdown, right? It is given and then it has gone above this, right? Fake breakdown is out here for a very, very small time, right? Now, this is one, right? This is very important. Sometimes what happens is during the market session, fake breakdowns happens, but the close price still honors. So how do you work on that? Is basically the price period, right? You should look at either breakout, right? Just looking at the breakout, and instead of close, you can go for only high. Now, when you look at this, only the high price is giving the fake breakout, right? Whereas so in this particular case, right? In this particular case, last index, this has given a breakout, but only the highs are giving breakout, whereas it's closing back. So if you're looking only at the close price, right? What you'll be looking at is this price or this price or this price, right? You'll not even know that such a false breakout has happened. So also along with that, what you could be looking at is if during the market session a breakout or a breakdown has happened, if you are using an algo trade, you'll be losing money on these things, right? Because what happens is the algo trade will not know whether it is high or not, right? It will simply say this is the price at that point of time. So you'll be losing certain money. Lot of false or a lot of stop losses would happen, and it will happen more during the choppy market or not in a strong trending market, right? So how do you add value to this is just looking at either close price or looking at only high or looking only at close or at low, right? So you have an option of close and this thing also, right? Any of you require more of this thing of spotting? So first thing what we did is bouncing from crucial support and resistance level, very important, should give you a lot of confidence. The second one is fake breakout, right? Wherein either the close price is breaking out for a very small period or a small percentage. The percentage is mentioned here, 0.75. If you increase the percentage, number of stocks that we are getting out here is 5. Perhaps you'll be getting more number of stocks out here, right? Still 5. Increase it to or reduce it to 0.25. Perhaps you'll be getting some more. No, 3 only, right? So that's a level. You can fine tune what percentage you are comfortable with the price breaching that particular level, right? And how many ticks this breach is happening. So if it is looking at coming back to 0.75, we had quite a few number of records out there, right? You'll see that so it is actually at least for twice, right? The breach out is happening at least twice in that period, right? At least twice. So that's how you can fine tune it. Any questions or comments on this fake breakout and breakdown before we go into some of the examples that we have? created for you some examples on fake breakout breakdown. So this one is what? Breakout, right? So we have an example of Balrampur Chini, right? So if you see, there's a small fake breakout which got spotted here. The next one example we have is Chambal Fertilizer, right? Small breach. Then the third example we have is Nestle. Nestle, a small breach here in terms of that breakout. If you see quite a few breakouts, small breaches there, but still it's coming out here, right? It's very powerful tool, very powerful, not very easy to find in a lot of stock analytical tool. We just added yesterday, so it may have improvement or two. But looking at in general, this looks pretty good. It's working well. We have tested it entire of last week with multiple different stock baskets and different ticks. Seems to be giving good results. We'll be fine tuning a little bit more, and that should give you better confidence. Use it to your fullest extent. Very powerful. If you like such high-end things, guys, again the request is basically share with your friends. That will help us, that will motivate us. Like and subscribe, and also the kind of innovations that we can do. We are clearly one of the most innovative when it comes to the stock analytical tool. More innovation will happen when there are more subscribers, right? More people giving this thing support, right? So that should give us a lot better confidence, right? So basically these are certain awe moments, right, which we have here. Like we have added quite a few things last week, and before last week we have added about 70-75 and fine-tuned 70-75 this thing candlestick. And similarly we are looking to add many more indicators and lot more fine-tuning strategy builders and so on and so forth, right? So your support will definitely help us to do better. Before we move on, let me quickly see if there's a question or two. Ankit, we have an alert service for everything that we have. There's an alert. The alert you can add on anything. So just go here, add alert from the screener, right? What kind of alert you are looking for? SMS alert, email alert, or web alert. You'll be able to get alert on any of the strategy. It's not only moving average. You can mix and match multiple things. You can add, let's say, for example, price above Bollinger band, right? Upper band, or you can add the price gainer. For example, price is gaining by at least 2% and volume and all this stuff, right? You can mix and match various different conditions. Once your strategy is good, do sort of back testing. Happy, you can add alert on the system. Okay. Vedanta, you look as fake breakout. Vedanta, Rakesh. Okay. Let's see Vedanta. Just taking. Rakesh, on which moving average? $50 moving average, simple moving average. I'll take that as. Yeah, right, quite a few ones. You have very well spotted them, right? Quite a few, but it happened quite some time back, right? So what you can do is you can see that. So basically, this was a better time, right? Where you would be looking at. Unfortunately, there's certain bad news coming out of Vedanta also, right? About certain debts and other things. So that's why the market is reacting very violently, moving down. Right. So that was a good spot, Rakesh. Right. Thanks, Muralidharan, for mentioning about this session. Can we get this on WhatsApp as well? WhatsApp, we are yet to integrate, but the plan is definitely to get WhatsApp. There are certain things which Meta, the basically owner of WhatsApp, right? They are not very consistent. They have changed quite a few policies. We were about to integrate a year back. They've changed 2 or 3 different policies. So haven't seriously looked at WhatsApp in last few months, but looks like that they have simplified it again. So if we feel that WhatsApp is simplified, we'll definitely get WhatsApp as one of the alert mechanism. WhatsApp gives us a lot better feature compared to SMS, because SMS is much more raw. WhatsApp can give you better idea and longer messages, right? So these are certain examples of fake breakout and breakdown. The next in this thing is other moving average strategies, right? So just hold for a second. I think I'll skip this one a bit. I'll show you one or two things more at this point of time. Just hold for a second. So what I'll do is I'll skip for a second before I move into the other moving averages. I'll give you 2 more features which are here. Number 1 is MACD convergence, right? For example, if you're looking at let's say 20 moving average converging with 50 moving average, right? That means the 2 moving averages, 2 simple 20 moving average is coming closer to 50 moving average. So if you are looking for such a screener, what you do is, in this case, the gap between 50 and 20 is lessening, right? So basically in last 20 ticks, the gap is lessening. That's again as something which can be used to can be used as basically looking at or monitoring a certain things, right? So in the previous ones, what we have seen is the moving average crossovers, bullish bearish. In this case, what we are looking at is they are coming very close to each other. That is a possibility of a convergence or a possibility of a crossover, right? So it gives you a heads up that that's likely to cross. Now there are quite a few stocks where the moving averages are converging, right? The 2 moving averages are converging, right? Number of ticks that we have seen here is basically in last 10 ticks, right? So another variation what you can do is basically if 20 moving average, right? It is any trend. Rising 20 moving average is converging with rising 50 moving average. What it tells you is that first of all 20 is rising, 50 is also rising, and they are also converging, right? So what you can do is it will help you to see that 20 is rising, 50 is rising, and they are coming closer, right? So in this case, just change it to slightly. So this is 10 ticks, right? So that's why there was only one stock which has come. Let's see if there are other stocks also coming. Good, right? So if you see these 2 stocks are converging. Had it been other way around, that means 50 is converging with 20. Okay, same set of stocks, right? So basically these 2 stocks both are rising and they are converging towards each other, right? For last 10 ticks, if you increase the ticks maybe to let's say 20 ticks, so you'll see some better convergence, right? So rising 20-day is converging with rising 50-day for at least last 20 ticks, right? So you see that that's a good sign that both are converging towards each other, right? So that means a likelihood of a crossover is happening, right? So similarly, what you can do is you can change it to a falling 20 moving average is converging with falling 50-day moving average. Okay, is converging with 40 is converging. Okay. So this is where if a smaller moving average is converging towards a larger moving average, or rather rising is better, right? Falling will be more for bearish signal, right? Both are falling and they are converging. That means the likelihood of it going down is higher, right? Right? Both are converging towards each other, right? So this is something where it will give you an idea that there's a likelihood. So we know how to work with moving average, basically crossovers, right? This will give you head start or heads up that they are likely to converge. what you can do is, if you can also add that the 20-50 moving average is within 20 moving average, within, let's say, 2% of moving average. Not sure if you'll find anything. Okay, no. Let's see on a weekly tick. No. 30-minute stick. Yeah. Okay. On 30-minute stick, we find two stocks, right? So the conditions that we have added, is, first of all, they are falling. Both moving averages are falling, right? And they are converging with each other, and they're very close to each other, right? So this is where you'll see 2% is too high actually. 2% is too high. Maybe we'll have to keep a smaller percentage, maybe 1% to give you better results. Nope. Okay. 1% on 15 minutes is way high. So maybe we do not have an example at this point of time, but I think you understood the concept, right? The moving averages themselves are converging towards each other, right? Likelihood of something happening. Just opposite of that is diverging, right? So when we say moving average, convergence and divergence, this, don't get confused with MACD. MACD name is also very similar: moving average, convergence, divergence. Of course, MACD uses moving averages, but this is slightly different than that. For example, do we have an example here? Which convergence, divergence? No. Okay. So let's take an example wherein again we take 20 and 50 moving average, right? Any trend. Basically, they are diverging, right? They are diverging after a crossover, right? They are diverging after a crossover. So what it tells you is about the trend strength. In one of the previous slides, what we have seen is the crossover has happened. That's one entry point, and if they are diverging, that should give you better confidence, right? So in this case, there's a moving average 20 and 50 crossover happened within last 10 ticks, and the moving averages are or the gap is widening. Right? So this is there and the gap is widening. That means the trend is strong. If the trend is strong, then the shorter moving average will move much faster than faster moving average. So this is one example. So the moving average crossover happened here and the gap is increasing. That means the overall trend is going higher. Right? Another example, moving average crossover has happened here and it is getting wider. Right? Not the perfect textbook example because it's very, very close. And the shorter moving average is likely to breach this level, but there can be better examples. Right? There can be better examples. The moving average crossover has happened and the gap is widening, so that should give you better confidence and strength. Right? Along with this, if you were to add another condition, trending, just go for 20 moving average, trending up for. No, not this one. Yeah, trending up with bullish crossover only for last 10 ticks. Nope. Last 5 ticks. Okay, right. This should give you better results. Right? The crossover has happened. The gap is widening. Right? Not very, very good examples. Which tick are we in? Daily tick. No, 15-minute tick. Okay, let's go to daily tick. Not very good examples. Not great examples. Not great examples. Unfortunately, so these are relatively high-end things, right? You'll not find a lot of examples at all point of time, but these are really, really good ones, right? To help you to filter the stocks of your choice. Okay, I hope the new additions that we did, right? The new additions that we did last week or this weekend release, fake breakout, bouncing, convergence, divergence, they are useful. Please do write comments whenever you feel that you have used it and you find it useful, or based on your other experience, if you find them to be useful, please do mention. or if there's an improvement area, we'll be happy to take your feedback and try to incorporate it there, right? The next one, the next one are there are certain other moving average strategies that we created. One is Hull. You remember, guys, Hull is faster than EMA, SMA, and WMA. This is derivative of WMA, right? Hull moving average. And Kaufman. Kaufman is for volatility. If you remember the slide that we have had about 10, 15, 20 slides back of what this is made of, right? Let's see examples. Hull moving average, very similar to any other crossover. You can use Hull moving average crossover, right? And then use the bigger moving average as stop loss, and then you'll see the response much better, right? So you can use it. Hull moving average will give you better response time compared to simple and exponential moving average, right? This is a very simple example of using Hull moving average crossover. Hopefully very soon we'll add Hull moving average screener also. Currently we do not have. Currently we have it, actually it's in beta, so we are still in testing phase. Once all the testing and everything comes in, and then we'll release that, right? Hull moving average, Gamma, VMA, DMA, quite a few moving averages, right? Now this example which team has got out, right? This very similar example what we have seen it. If we were to see the moving average crossover of Hull, this has happened here, almost very close to the price movement. If we had waited till exponential moving average, right, we would have lost this kind of movement, right? We would have lost this kind of movement, right? So what the idea of this particular slide is to tell you that what is the difference between Hull and EMA crossover, right? Hull happens almost instantaneously, almost along with the price, with minimal or no lag, whereas EMA is slightly slower. When we say slower, is it happens after a certain point in time, right? So Hull moving average will give better. Similarly, the reverse crossover, Hull happened almost along with the price, whereas exponential moving average took a lot of time. So if in this particular example, the exponential moving average gave an entry point here and exit point here, again, not a bad thing. There was some money to be made, but the amount of money to be made here is much lower compared to the this Hull moving average, which has given much better, right? Use Hull or exponential to best of your understanding and discretion. The faster moving average, the more the false signals are. The next one is Kaufman, right? If you see, this is Gamma, as a short form is called Gamma. Just look at that. Again, they're likely to give you both a bearish and bearish signal, right? So look at them. So this is bullish, bullish, bearish, then again bullish, bearish. So similar to any other moving average. What it will help you is it will be basically eliminate some of the noise, right? This moving average gets much flatter compared to a lot of other moving average during the sideways market, right? Much more reactive. Again, a very good and powerful moving average. Now, what we have covered is moving average introduction, some of the good strategies, basic strategies of this thing, right? Now, moving average can be used with other technical indicators, right? Like what we have discussed in previous sessions. So some examples we have over here. I'll not go very deep into it, but I'll just keep certain examples for you to see. This is typically for intraday period 5 and 12 moving average. So here the moving average has crossed over. Also at the same time, RSI is crossing above 50, right? That means RSI was below 50, which is at a neutral level. It is crossing above, a positive indicator. Along with that, if you see the moving average crossover is happening, that will be a good entry point, right? Similarly, the exit point, both the moving average is crossing below and there's an exit point. So just remember this strategy. I won't go too deep into this, just for your basically based on our experience and based on our research, we found this to be a good strategy, right? So get there. A lot of things are mentioned out here. Another one, just opposite of that, so won't take much time, right? It's just opposite of that, what we have seen. Another good strategy is moving average with awesome oscillator, right? So price crossing above moving average, right? Awesome oscillator giving sort of positive momentum in the trend, right? Get there, and then negative momentum, awesome oscillator falling, right? So look at all the sources and other patterns, right? If you use awesome oscillator, familiar with this, then use them. You can also add this thing in the screener. Moving average with stochastic. I'll give you guys a couple of seconds to see. Okay. Another example. Moving average on indicators, right? We have briefly seen moving average on other indicators, right? So this is an example where moving average is plotted along with RSI is plotted along with its moving average. So what it means is RSI is breaching its own moving average, a bullish crossover. That's a good signal to get in, and a good signal to get out is when it comes down, right? Works very well in a trending market, right? Works very well in trending market. In choppy market, there'll be a lot of poor signals, right? So use this signal as a good powerful signal. Use this along with a lot of other things, right? So you can plot moving average with RSI on other indicators. Similar example we have with another indicator called awesome oscillator. Ultimate oscillator. So look at that. There's certain example which is mentioned here. Indicators based on moving average, briefly touched upon. There are about 30, 40, at least, or maybe 50% of the indicators, technical indicators, which are directly or indirectly based on a moving average. MACD, Bollinger are directly on the moving averages. Envelope is also directly on that. Even RSI and many stochastic, many more indicators. Any indicator which comes with signal line, the signal line is generally a moving average, mostly exponential moving average of some sort. Like MACD, the 9 is the signal line, right, of a EMA. So similarly, this one is simple moving average. This can be any moving average, right? Simple exponential weighted. Moving average based strategies, envelope, will not go too deep into that. We have covered MACD and Bollinger in greater details in some of the sessions before, so we'll not touch them again. Simple examples. Moving average, crossover. Again, this is crossing above a certain level. Moving average, entry exit points. This one, Bollinger Band, the central band is 20 MA. So you can use as an MA, or you can use as a middle band of Bollinger, both are same. Price crossing above its volume MA. So in this case, it's crossing above its volume MA with good green candle, breaching the previous recent swing high. So you can use this also as a combination, right? So just plot volume moving average. We have briefly seen how to plot volume moving average here. So this should act more for price action, guys. This should act as a good one, right? So 50 moving average is also breached, as well as this. A previous recent swing high is also breached, right? So quite a few things which are matching this condition. Common periods of moving average, popular number. So most of the popular numbers are basically round numbers, right? But of late, a lot of research is done thanks to the computing power and availability of tools like us available in the market. People have tried. Earlier, people were pretty much into this thing, and most of the big institutions, they still follow this. More popular numbers which has come out of back testing using tools like us. Some other numbers which are also working very well is basically the 12, 21. In fact, 13, 34 is also very good numbers, 44, 52, right? So depending on some of these moving average, you can use other moving average, right? Of late, 12, 21, 44 are quite popular, right? Other than that, 13 and 34 is also very good, right? Use them. Some analysts use only Fibonacci numbers for the moving averages. That's where the 13 and 34, you remember, 13, 34 comes in, right? So that comes out from the Fib numbers. right? They also act as very, very good levels for moving average. What should you use moving average? For basically extremely aggressive traders, scalpers, use the faster ones like Hull or EMA, right? Use the smaller numbers. For day traders, you can get into SMA also, but slightly bigger numbers. The number here starts with 3, right? The number goes much bigger numbers. For swing traders, use simple moving average, comma, 20, 44, 50. For long term, go for 50, 100 and 200, right? So this will be a typical, depending on what you are looking for, you look for these moving average, okay? Then moving averages in TSR. So I'll just take a pause to see any questions. Do you have any plans to run in-person classes? We have discussed that. How do you find what are the stocks which gives false breakout on yesterday? So DD, what you can do is on the false breakout, you can go and look at the, so basically in this one, you have an option of going back in the history to see where the false breakout is, right? So any screener that you're looking for today, you can look how it looked yesterday. This is called, we call as time machine. You can go back in the history, say that what happened 10 days back or 15 days back and so on and so forth, right? That's where you'll get it. Okay, thanks Nicer24, Kuldeep Singh Call, thanks. Then can you incorporate VWAP? Yes, we are working on that. VWAP is there in the charting already. In the screener, we are yet to add that. We'll get there as we move to 1 minute data. Does day trader mean intraday? Yes. Intraday means day traders are something who take the position in the morning and close the position in the evening, right? They don't want any surprise, overnight surprises. That's a typical day traders are, right? Get entry in the morning and get entry before maybe 3 or quarter to 3 or 3:15 latest. Okay, so we have briefly seen, we have certain pre-screeners created. Custom screener, you can add multiple moving average in one. You can choose any period, right? Built-in strategies for finding quite a few things. You can work on various fields, open, high, low, close, volume, other indicators. New launch are fake breakouts, bouncing, convergence, divergence, which we have added, right? Equity analysis, we have briefly touched upon equity analysis out here, right? So I don't want to get there. I want to complete it so that you guys get timely lunch. Backtesting, we have briefly seen that, right? And also in other sessions, so I won't cover that, right? Moving average, you can add alerts. Somebody asked alerts, right? You can add in a watch list, custom templates. So basically in the overviews of the product overview, we have covered all these things in greater details, so I won't want to repeat it or bore you with that information, right? We have so similar to what we have for this thing, right? And this is completely enhancing. We have completed candlestick class couple of weeks back. We have enhanced it, added a lot of screeners. Like for Marubozu, we have added quite a few things out here with a lot of examples. Somebody was asking for the slides, right? Slides would be pretty much on this one. Similar to that, we have a session, we have a brief tutorial on this thing, candlestick, on moving average. We'll be enhancing it with all the latest and greatest examples with all the strategies. So keep coming to this one. You'll see lots of improvements which will be coming out here and a lot of enhancements coming out here. Okay. Then I think that's about it. Before we wrap it up, a gentle reminder to you guys, right? If you find this thing, if you find our time worth spending, then please share with your friends, subscribe it, like it, right? That's our oxygen, as we have mentioned, right? And it really helps us a lot, right? We'll be coming with a lot more sessions. At least we'll try to get 2 sessions. So the idea was to give you brief or introduction. In certain cases we have gone deep dive, certain cases we have taken a lot of your feedback and incorporated that here, right? We'll keep doing that. Before I say thank you and goodbye, let's see any questions. Do you incorporate pre-open market data as well? No, Ankit. Pre-market, we do it with So basically in the screeners we don't include pre-market, but we do have certain screeners for pre-market, right? So at around 9:10, the screeners that you run would be with the pre-market. That means the market closes around 9:07. So you'll see at 9:10 you'll see the screeners showing that set of data. So we have partly implemented that, not complete, but we do have some of these things, right? Thanks, Sanjay, for mentioning that. Yeah, Didi, there's a question. Can you repeat that question? What you have? Just paste it back. In most of the examples, the price are either reached top or went down. Kindly explain proper entry points. Okay. See, proper entry points are moving average crossovers, right? So either they are price. The best entry point is basically when the price is crossing above a certain moving average. For example, 50 moving average, the price is crossing, right? Price is crossing above certain moving average. This is a good entry point, right? Now it will show you quite a lot of stocks, right? Some of them would be not so good, some of them would be good. So you start research on that, right? Now if you see in this particular case, so there was a consolidation and then market clearly went down. There's a sort of a very, very loose, if I may say, reverse head and shoulder, right? This is reverse head and shoulder. That should give you some confidence. If you see, the reverse head and shoulder is actually a little bit twisted kind of a reverse head and shoulder, right? It has breached out. So that's one positive signal. You see that there's some of these things, moving average crossover. So this can be a good entry point, right? This can be a good entry point. Similarly, this does not look like a good entry point. There's hardly anything. There's a lot of crisscross, not a good entry point. This one again does not look like a great entry point. There's a lot of crisscross unless this level is breached, not a great point, right? This looks like a possible entry point. You may want to look at some of the other style, right? So there's a good gap up. The volume is also pretty decent. So if you plot a moving average of the volume, right? Maybe we plot a moving average on volume of maybe 10 days, right? So oh, sorry, our moving average is gone, right? 50. Yeah, right. So this is where the breach is. So you see there's a good gap up, good green candle. That should give you confidence, right? If had it been with slightly higher volume, right? The reason why, also you have to look at the moving average, right? If it is simple moving average, you won't see that there's a crossover. But here, if you change it to, let's say, Kama, right? No, Kama is okay, no, bad one. Exponential moving average, no moving average is breaching there. Waited, right? No moving average is breached because there was a huge volume out here, right? So that's negating some of the effect of the latest moving average, right? That's negating some of the thing. But looking at the structure, this looks like a better entry compared to the previous one. This one looks even better entry, right? There's good sort of momentum getting built there. Good momentum getting built there, right? This looks like the moving average is also higher, right? So this is where the previous swing levels are there, right? So definitely it's likely to touch here. If this is breached, then perhaps this level would be a better level, and then there are even higher levels, right? So this is how you would be entering the place, and then you'll be increasing your stop loss. So look at this. Look at this levels. This level will be a good target, right? Good target, second good target. If this is breached, then increase your stop loss and go on, right? So I'm not sure if it explains you. The complete explanation would be pretty difficult, right? In such a short session, but this will be a better entry point. So use this as first filter. This one does not look great, right? So this is not a great entry point. So this one looks better, a long good green candle, right? Breaching all the previous levels. If you see, if you change it to, let's say, line, right? So it's clearly breached the previous swing levels, right? Likely to breach this one with the kind of momentum that we see out here, right? So likely to see there's a big green good candle, right? So if you go into 2 minutes chart, 2 days chart, perhaps you'll see the morning star also along with this, right? So there's a lot good pin bar out here, right? Good pin bar is there. There's a lot of dojis. After this sort of a small candles, there's a huge big candle which should give you better confidence, right? So the idea or the key to success is to mix and match other stuff, right, along with the most basic stuff. Okay, I hope that answers your question very briefly. Then it was indeed a great session. Thank you, Ankit, for mentioning that. Then link of your YouTube channel. Anushka, can you share that, please? All right. So that was a brief session. I hope that time was well spent. I hope that there was some learning for you or some new things coming for you. Also, it was good for us to show at a time where we added few things. Very soon, what we'll be doing is the way we have done for the so back testing. We are coming with 4 different phases, right? First phase is the simple time machine, which is there. You can use them. The second thing is what we'll be doing is along with these 3 moving average, Kama is there, but it's only for the internal team. We are still doing some testing before we release. You will be seeing many more moving average. Hull definitely you'll see. Hull and Kama definitely you'll see. You'll see VMA and DMA getting in here in coming days. Another thing what we'll be doing is currently the historical pattern finder. If you were to create a template, you have options of candlestick, high Kanashi, narrow range, wide range. You'll be seeing the back testing or the historical patterns on moving average also very soon. Okay. So these are certain enhancements which are coming. Now I guess, guys, we have answered most of the questions also out here, right? So thank you very much for taking time on a off day and also staying with us for a really long session. To us, taking time out on a weekend is very good. So much appreciated. We hope to see you in coming sessions, right? Till then, tata, bye-bye, and thanks all. Thanks from the entire TSR team who made it possible to build this entire presentation, entire slides, along with the testing of the product, enhancement of the product. So there's a lot of work which has gone in, a lot of efforts have gone in last week or so, doing 3 or 4 things together, right? But I hope that the time spent by us is valuable to you, and you'll get full benefit out of it, right? So till then, till we meet again, tata, bye bye, see you very soon. Yeah.